let's find out perhaps some of those painful choices that the IMF is warning Nigeria about with the Chief Executive Officer of Financial Derivatives Company, Mr. Bismarck Rewane. Mr. Rewane, good morning and welcome to the program. So I know you've been following conversations at the IMF, and I mean, we just heard there how they are talking about painful choices that Nigeria would have to make among other countries, if I may add. And a lot of Nigerians thought that the painful choices were over with the reforms, which included, of course, the removal of fuel subsidy and all that. What are the painful choices do you think Nigerians should prepare for following the conversation there from the IMF?
Unfortunately, a lot of us continue to think of the past rather than the future. What was appropriate and what was adequate in 2023 may not be appropriate and adequate in 2025. So the fact that we removed subsidies in 2023 or reduced subsidies in 2023 allowed for an alignment of our exchange rate does not mean that you do nothing else. Those things were necessary but not sufficient. What makes it sufficient is what we're looking at in the future. Today, is IMF in the Article 4 review is projecting that our inflation rate, based on the new methodology and new basket, is going to increase to 30% this year, and it's going to increase to 37% next year. That calls for us to pause and take a look at what we're doing. At the first segment of this program, you did say that the debt management office is reducing the amount of bond issuance. As a matter of fact, based on what the IMF is saying, and based on the fears that inflation is likely to spike again for a number of reasons, that is the more reason why we should increase the bond issues that we're making so that we can mop up more liquidity out of the system, not to reduce it. From 1.8 trillion in the first quarter to 1.2 trillion this quarter is actually moving in the wrong direction. So that's one of the painful choices. Secondly, let us ask ourselves that why would the IMF be projecting inflation at 30% when today where inflation is at 24%? The reasons are simple. One, if you look at the monthly inflation of March, the monthly inflation came in at about 3.4% or so. When you analyze it with the formula, it comes out at 58%. The month-on-month inflation is a much more accurate reflection of inflation than the year-on-year inflation because you are comparing last year with this year. But this time we are comparing February and March. Therefore, you will see that in this month-on-month inflation of 58%, it tells you that maybe the IMF have seen a few things that will make them worry about inflation increasing to 30% this year rather than declining. What are the factors that cause inflation, and why should we be looking at it to dealing with it immediately? One, the price of oil. Today, the price of oil, you just said it, is $66 a barrel, and OPEC is threatening to increase their production. If you take $66 a barrel, at a time when the dollar has fallen by almost 12% against the basket of currencies, the effective price of oil you're getting is actually about $54 a barrel, because you have to discount that 6% by almost 10 or 12% of the reduction in value of the dollar. What does this mean? It means that the Nigerian government and other oil-producing countries will have to look for additional money, right? And the fiscal deficit, that is the amount since their revenues are falling, the amount they are going to spend will have to reduce, or they will have to borrow more to meet that spending. That's where the crunch. Now, secondly, Dangote has helped us by bringing down the price of oil, and the price of PMS, and the price of diesel. But for how long can this continue? We believe that it is possible that the prices begin to find fair value, comparing it closely to those of our neighbors, because we are selling our petrol for about 70 cents, while the neighbors are selling theirs for about $1.20. So at one point in time, the price of our petrol and the price of petrol in neighboring countries begin to get closer to equilibrium.
All right, Mr. Rewane, before you go on, please, let me just try to understand this. And I'm glad that you referred to the reduced domestic borrowing plan of the federal government, especially for the second quarter of the year. And also, we are still having that drop in the oil prices, while our production is still not hitting, even the target, not to mention the 2 million that we aim for. So where else can because, I mean, the budget still hasn't changed. The deficit is still above 13 trillion naira. So where else can the government go to fund the budget?
Well, you see, it's not that the government went into the market to go and bring the price of oil down. You see, all of us are responding to the tariff and trade wars. So these were unexpected exogenous variables. And therefore, we respond to them and also plan for the future. So Nigeria, as a matter of fact, is one of the countries that have been least impacted by this amongst the African countries. But that does not mean that we are not going to face the squeeze. The squeeze is here. So with the dollar, about a month ago, it was $1.27 to £1 sterling. Today it is $1.33, 34 to £1 sterling. That tells you what it is. So if you sold your oil at $74 last month, and you are selling it at $66 now, and you use the proceeds of the dollars to buy pounds, you are getting fewer pounds than you would have gotten. So the effective price of oil has dropped, and that means that there's a fiscal gap that we have to fill up. To fill that fiscal gap, we need to borrow money, or, God forbid, we have to reduce our expenditure. If we reduce our expenditure, then we begin to feel that squeeze. Not only that, we also have to block the leakages. And the real problem here is that as long as leakages exist, as long as there's no fiscal consolidation, as long as there's loose spending, you will have the side effect of what we are facing today. And so, again, we always say that let us prepare for the worst and always hope for the best. Now, this is the situation. Not just Nigeria alone, but everybody in the world is making very serious adjustments. You can see it in China, you can see it in Singapore, you can see it in Europe, the European Union.
So now that President Trump is signaling less tariff for China, can the world, including Nigeria, expect things to soften a bit, and all those downturn of forecasts of economic growth and high inflation, can we expect it to be tapered with a bit?
No, you are right. The truth is that these are exceptional times, and therefore I do not believe that the world can actually live with this kind of unexpected gyrations. Therefore, we believe that by May, June, things will have stabilized. We'll get back to normal. There'll still be some uncertainty here and there. So the wild projection to say that the world will go into a recession, 60% probability, yes, there may be a recession, but it may be a mild recession rather than a deep recession. So I don't share the pessimism of inflation going to 30% or 37%, but I do also, I base my projections on realistic assumptions rather than optimistic assumptions. So while I don't share the pessimism, I am not going to go overboard to be overly optimistic. I'm being cautiously optimistic and more realistic than many other analysts.
All right. So even the IMF has warned Nigeria about spending. Back home here, at least 5 times I've had you on the show, and you've talked about blocking leakages. Do you hear conversations about cutting our expenses, even if it means, changing a few things on the budget, or making some changes in the administration or running of the government to meet up with this issue of reducing our expenses to meet up with our reality of today?
There's a big difference between expenses and investment. Expenses is what you spend on the daily routine. Investment is you are investing for the future, and you have an investment multiplier. I think that cutting expenditure is not the same thing as optimizing expenditure. If you can buy a car, right, for 200 million, and somebody brings an invoice and says you should buy it for 300 million. Maybe the invoice comes from a credible party, and you spend 300 million, while in fact you could spend 200 million. That is what the IMF is talking about. Optimize your expenditure. Make sure that there's value for money. In most cases, both at the state level and the federal level, there's a lot of fat and leakages in the system, and the leakages are a negative investment multiplier. We can't afford it, especially at this time. But to ask us to cut our expenditure at a time when we need to invest more, is like asking a man with ulcer to go on a fasting mission, right? Even the Quran and the Bible says that if you are ill, assuming that you have an ulcer, you are exempted from fasting. So Nigeria should be exempted from fasting at this time. But also, if the fact that you are exempted from fasting doesn't mean that you should go on a binge and start spending money as if a drunken sailor. So somewhere in the middle, Nigeria will invest more, optimize its expenditure to make it more efficient, and then the results will show for themselves. We cannot continue saying that, oh, the IMF is wrong in its projections, the world is against us, the price of oil is falling because of certain things. But the production of your oil in your oil-producing areas are suffering because of your own lack of security. You talked about it earlier. So if there's a security failure and you are not producing enough, and on top of that, the price of oil is dropping, then you have a double jeopardy. You do not need that at this time. We need this as much as we need a bullet in our heads. So let's focus on what's going to happen next. I think that the global uncertainty will reduce. We think that the price of oil will come back up marginally. We think that also that inflation is not going to go as far out as 30 or 37%, but it will still go higher to about maybe 25, 26, 27%. And then it means that the central bank will now have no choice but to maintain the current rates or even increase them to ensure that liquidity, the liquidity saturation does not hurt us in terms of inflation expectations. I think that is very important. But luckily, the price of petrol is down. Luckily, we are seeing some increase in production, but we are also beginning to see here domestically that price of commodities are now beginning to increase, and for a number of reasons. And that we have to deal with that immediately. As far as
I'm sure one of the reasons to be insecurity, it's been really bad in the last couple of weeks.
Yes, it is. And the security situation, first of all, it increases anxiety, it increases investor skepticism, but also makes sure that it doesn't enable goods to move from one part of the country to the other. So you are beginning to see an inflation differential. You see the same price of commodities that you could see in Lagos at a particular is some very high in Kebbi or somewhere because people cannot go there to buy the goods that are there, or people cannot even send goods there. So security is a recurring decimal, and either politically motivated or otherwise, it is something that we cannot afford at this time. So we have to deal with our security, both in the Niger Delta where the oil vandalism is taking place, both at the food basket in Benue State and also in Kebbi and in North Central. Insecurity is what we do not need at this time at all. It's the worst thing to happen at the worst time.
So do you see the government turning to, I mean, we've talked about diversifying the resources or the source of revenue for Nigeria for so long. I wonder if we still need to talk about it. But non-oil exports could be a way out at this time. But, I mean, even in that aspect, we still have a lot of deterring factors.
Yeah, so non-oil exports, let's take it easy. First and foremost, cocoa. Cocoa is about almost 9,000. As a matter of fact, the cocoa, the constructed manufacturers, KitKat and others have actually said that the rising price of cocoa is over and that they are happy to have it at $8,000, $9,000. That is 4 times higher than what it used to be 2 years ago. So we'll make a lot of money. We expect to make at least $3 billion this year from cocoa. From fertilizer exports alone, we are expecting to make over $4 billion. From service sector, diaspora remittances, entertainment, movies and others, Spotify, we are going to be making a lot of money. So the picture, the long run picture, in fact, the short run picture is not that bad. The only thing that we do not have, that we have control over, that we are not doing, is blocking the leakages domestically, both in the public and private sector. So what are we seeing? We are seeing people domesticating their debt. So a lot of companies that were borrowing internationally are now borrowing domestically so that they don't suffer from the exchange rate losses of the past. And you were on the stock market yesterday and you saw all the numbers looking green. We expect some more green today because the Nigerian breweries announced the results and it was excellent. So more results are going to come out for Q1, which shows that on a quarterly basis, the companies are now beginning to break even. And you can see the stock market yesterday gained, and you announced it on the business news. Now, if that sustains itself, and the central bank maintains the discipline of ensuring that foreign exchange is available and there's price discovery, and the Ministry of Finance reins in excessive expenditure, then the picture for the second quarter for Nigeria will not be as bad as feared. And I think that is good news at this time. But again, that doesn't mean that because the price of oil has come down to $60 a barrel or lower than that, we need some belt tightening and we need to optimize the use of our resources and we need to get value for money. We cannot spend 300 million naira for something that is worth only 200 million or 150 million naira. We cannot throw money away at this time. We can ill afford it, both politically or from an economic perspective.
All right, Mr. Bismarck Rewane, Chief Executive Officer of Financial Derivatives Company, thank you so much for your perspective.
Thank you for having me.
Let's take a break. When we come back, a conversation we had yesterday about the Raw Materials Research and Development Council bill. We had one perspective. We'll see the other perspective this morning. After the break, please stay with us.